Imagine you are standing in a grocery store aisle, and you have $20 left in your checking account until payday, which is 3 days away. You need milk, eggs, and bread. The store brand costs $4 total. The name brand you prefer costs $6. You have purchased the name brand for years without thinking about it. But today, with $20 and 3 days, you put the name brand back on the shelf and reach for the store brand, without any internal debate. That is not a character flaw. That is not a lack of discipline. That is the cold, predictable mathematics of scarcity. And it explains more about financial behavior than any advice about willpower ever could. The math behind broke behavior is not about what people know. It is about what their bank balance allows their brain to do. Most financial education assumes that good decisions come from knowledge, and bad decisions come from ignorance. That assumption is comforting because it implies that teaching people more facts will solve the problem. But it is also wrong. Researchers have spent decades studying the cognitive load of poverty. And what they have found is that scarcity itself, the condition of having less than you need, actually reduces cognitive capacity. In a landmark study, farmers in India were tested on the same cognitive tasks before and after harvest. Before harvest, when they were cash poor and stressed about making ends meet, their performance was comparable to losing an entire night of sleep. After harvest, when they had cash in hand, the same farmers performed significantly better. Their intelligence did not change. Their financial constraints changed. The math behind broke behavior is that scarcity taxes your brain just as surely as a sleepless night does. Let us walk through the math of how this works. Your working memory, the part of your brain that holds information while you process it, has a limited capacity. Psychologists estimate that under normal conditions, an adult can hold roughly 7 discrete pieces of information in working memory at once. Every financial decision requires you to hold several pieces: your current balance, upcoming bills, the price of the item, the opportunity cost of spending now versus later, and your emotional state about money. When you have ample resources, those pieces fit comfortably in working memory. You can compare, calculate, and choose. When you have scarce resources, the stakes of each decision are higher, which adds emotional weight to each piece of information. That emotional weight consumes additional cognitive capacity, leaving you with less room for rational comparison. You are not dumber when you are broke. You are simply running more expensive mental software on the same hardware. The mathematics of this cognitive tax is measurable. Researchers have found that the mental strain of financial scarcity can reduce effective IQ by as much as 13 points in the moment of decision. 13 points is the difference between average and above average. It is the difference between catching a mistake and missing it. It is the difference between noticing a hidden fee and overlooking it. And here is the cruelest part. The people who need the most cognitive capacity to escape scarcity are the ones who have the least available, because scarcity itself consumes that capacity. This is not a moral failing, it is a feedback loop, written into the mathematics of how brains interact with money. Now zoom in on a specific behavioral pattern that emerges from this math. People living under scarcity do not make worse decisions about everything. They make worse decisions about money specifically. And they make worse decisions about long-term trade-offs generally. But they often make excellent decisions about immediate survival. The store brand over the name brand is a correct decision given the constraint. Not buying the optional item is correct. The problem is that the cognitive tax spills over into other domains. The same farmer who makes perfect planting decisions before harvest might miscalculate loan terms after harvest when cash is low but before the new cycle begins. The same worker who never misses a shift might sign up for a high-interest credit card during a slow month because the immediate relief overwhelms the long-term calculation. The math does not make people irrational. It makes them rationally focused on the short term because the short term is genuinely more dangerous. Let us look at the systemic consequences. When thousands of households are operating under scarcity taxes, whole markets shift. Payday lending exists because the math of scarcity makes a $40 fee to access $200 today feel reasonable when the alternative is missing. A rent payment. Late fees exist because the cognitive tax makes people forget due dates they would normally remember. Overdraft fees generate billions of dollars annually not because people are careless, but because the scarcity that causes low balances also causes the cognitive slippage that leads to overdrafts. The system is not exploiting ignorance, it is exploiting a predictable mathematical relationship between account balance and cognitive function. The broke behavior is not a bug, it is a feature of how the math works. Historically, this pattern appears across every income level. During the 2008 financial crisis, households with significant home equity, but low liquid savings made the same cognitive errors as much poorer households. Their net worth was high, but their available cash was low, and the scarcity of liquidity taxed their decision-making just as effectively as any poverty condition. They held onto falling stocks because selling felt like a loss. They delayed necessary home repairs because cash felt too precious. They made mathematically suboptimal choices, not because they were wealthy or because they were poor, but because the math of their liquid scarcity produced the same behavioral signature regardless of their net worth. The threshold is not about total wealth, it is about the ratio of available resources to immediate needs. So what does this mean for you practically? The first implication is that shame is useless. If you have ever looked back at a financial decision made during a period of scarcity and thought, "Why did I do that? I know better," the answer is that your brain was mathematically constrained. You did not lack knowledge. You lacked cognitive bandwidth. Beating yourself up for that is like beating yourself up for being tired after staying awake all night. The second implication is that the solution is not more education. The solution is reducing the cognitive tax by reducing scarcity itself. That sounds circular, and it is, which is why escaping scarcity is genuinely difficult, but the math offers one reliable escape route. Automate everything that requires willpower. Automation moves decisions from the taxed present self to the unconstrained past self who set up the system. Consider the math of automation. If you automate a 20% savings rate, you never make a decision about how much to save. If you automate bill payments, you never decide whether to pay on time. If you automate investment contributions, you never hesitate because the market feels uncertain. Each automation removes one decision from your working memory during periods of scarcity. Removing that decision frees up cognitive capacity for the decisions you actually need to make. The broke behavior is not that you make bad choices. The broke behavior is that you have to make too many choices at all. Wealthy people do not have better willpower. They have fewer decisions to make, because their systems handle the routine ones. Let us put numbers to this. The average person makes approximately 35,000 remotely conscious decisions per day, according to cognitive psychology research. Most of those are trivial, but financial decisions, even small ones, carry emotional weight. If you can reduce your daily financial decisions from 20 to 5 through automation, you free up 15 decision slots worth of cognitive capacity. That capacity can then be applied to the genuinely important choices: career moves, major purchases, investment allocation. The broke behavior pattern is not broken decision-making. It is decision overload. And decision overload is a math problem, not a character problem. The final piece of the math is the compounding of small cognitive savings. If automation saves you 15 minutes of mental energy per day, that is 91 hours per year. 91 hours of cognitive capacity that would have been spent on trivial financial decisions can instead be spent on learning, resting, or working. Over a decade, that is nearly 1,000 hours of brain function that you did not lose to the scarcity tax. That 1,000 hours is not going to make you wealthy by itself, but it will make you more likely to notice opportunities, more likely to avoid mistakes, and more likely to persist through difficult periods. The math behind broke behavior is not a life sentence. It is a set of equations, and once you see the equations, you can change the variables. You cannot always change your balance quickly, but you can always change your system. And changing your system changes the math that runs your brain. So if you take nothing else from this, take this one rule: never make a recurring financial decision manually. Every bill, every savings transfer, every investment contribution that happens more than once should be automated. The moment you automate a decision, you remove it from the scarcity tax. And over time, removing enough decisions from the tax is mathematically equivalent to increasing your cognitive capacity. That is not motivation. That is arithmetic, and arithmetic does not care how you feel about your bank balance. It just works. Or it does not. The choice to automate is yours. But the math of why you should is not an opinion. It is a description of how your brain already works. Broke behavior is not broken. It is math. And math can be rewritten.